the staggering macroeconomic imbalance. Right now, India accounts for nearly 15% of all global music streaming volume. Driven by deep mobile penetration, it is the fastest growing music market on Earth by pure consumption. But despite that massive scale, India contributes a microscopic 2% of the global music industry's actual financial value. This chasm exists because the Indian music ecosystem was built almost entirely on an ad-supported free consumption model. Last year, out of roughly 4.8 trillion music streams in the country, over 4.6 trillion generated only fractions of a cent through digital advertising. That math is finally changing. Paid audio subscriptions doubled to 700 crore rupees recently, and the total paying subscriber base is projected to reach 250 million over the next few years. Because subscription streams typically generate 3 times the revenue of ad-supported streams, this shift acts as a high-yield multiplier on existing volume. Positioned directly in the path of this value convergence is Tips Music. They are a pure-play, aggressively asset-light music label that owns the underlying intellectual property to a massive chunk of this digital consumption. To understand if this equity is a viable investment, we need to conduct a fundamental forensic and valuation stress test to determine if its underlying cash generation mathematically supports a 5x return over the next 5 years. To evaluate that potential, we have to deconstruct how Tips actually makes its money. Their revenue engine operates across 4 distinct business verticals. This graphic lays out their primary engine, digital music licensing. By leasing their sound recording rights to platforms like Spotify, Apple Music, and Amazon, as well as executing global distribution deals with Warner and Sony, Tips earns recurring royalties every time a user hits play. The second vertical is active music production. They acquire and create new music rights for Bollywood releases, regional cinema, and independent artists, constantly feeding fresh intellectual property into their global distribution network. Vertical 3 is YouTube monetization. Tips commands a footprint of over 145 million subscribers. Crucially, they are transitioning YouTube Shorts from a fixed-fee model to an advertising-led revenue share model, opening up a highly scalable vector for future cash flow. Finally, to keep the pipeline alive, they adhere to a strict capital allocation strategy. They systematically reinvest 25 to 30% of their top-line revenue right back into acquiring new singles and albums. Together, these 4 verticals operate exactly like digital real estate. You deploy capital upfront to acquire or build the intellectual property, and then collect high-margin, recurring rent on those assets for decades. But digital real estate is only valuable if it is defensible. Tips protects its margins through 4 specific structural moats. The first is an unreplicable legacy catalog. They own over 34,000 songs spanning 25 languages. Remarkably, roughly 85% of their revenue is generated by older tracks, primarily hits from the 1990s and 2000s that continue to trend and drive huge volume today. The second moat relies on structural network effects. Streaming platforms need massive, established catalogs to attract and retain paying users. This dependency gives legacy labels significant leverage in negotiating licensing deals. Third is brand recall. Having operated as a dominant player since the 1980s, their established status acts as a magnet for top-tier talent, materially lowering the friction of acquiring new artists. The fourth moat is an aggressively asset-light architecture. Scaling this specific business model requires 0 factories, 0 physical inventory, and no major capital expenditures. When you combine an irreplaceable legacy catalog with 0 physical capital requirements, you create a nearly impenetrable barrier to entry for any new competitor trying to build a label from scratch. To see if these qualitative advantages translate into cash, we have to run a strict fundamental analysis. Looking at the top and bottom lines, the digital expansion is visibly paying off. Recent quarterly filings show revenue growing 21%. While peer companies capitalize content costs and amortize them slowly, Tips takes a radically conservative approach. They expense all new content costs immediately. Once absorbed, catalog revenues flow directly through as pure profit. Because of this cash-rich dynamic, the company carries a debt-to-equity ratio of absolute 0. Furthermore, comparing operating cash flow to profit after tax proves the earnings quality is exceptionally high. Ultimately, these metrics reflect the unit economics of a software company. The conservative accounting policy simply disguises the massive long-term leverage embedded in their IP. High margins mean nothing if the cash isn't real. We apply a forensic checklist. Checks 1 and 2 look at cash conversion, ruling out fictitious revenue. Checks 3 and 4 confirm arm's-length transactions and unpledged promoter holdings. Finally, checks 5 and 6 correlate revenue with streaming data and validate cash through dividend payouts. The forensic stress test clears the company of standard corporate governance red flags. The numbers on the income statement are translating directly into cash in the bank. With the historicals verified, we can look forward. Future growth relies heavily on a few key levers: deepening mobile streaming penetration, monetizing YouTube Shorts via revenue share, and scaling international royalty collections. But those levers face serious friction. Tips must navigate intense market competition for new content, regulatory shifts, execution risks in their pipeline, and the persistent threat of tech platforms leveraging their size to renegotiate payout structures. Pricing this in the public markets, Tips trades in line with historical averages and peers, sitting at a price-to-earnings to growth ratio of roughly 1.3. So what math delivers a 5x return over 5 years? A 500% gain demands a compound annual growth rate of roughly 38%. Achieving that is a mathematical gauntlet. It requires top-line revenue to compound above 20%, profit above 25%, flawless execution, and zero multiple contraction. Tallying the final scorecard, Tips features a highly defensible business model, robust moats, pristine financial quality, supreme cash flow, and a clean forensic profile. While modeling a guaranteed 5x return over 5 years requires highly aggressive assumptions, the foundation is undeniable. With an asset-light royalty engine, zero debt, and a massive legacy catalog, Tips Music stands as a premier compounding vehicle built to capitalize on the digital convergence of the Indian music market.